Maneco64, home of alternative economics and contrarian views. So I pre-recorded this message for Christmas Day and Boxing Day. I will be going back to normal on Tuesday the 27th. So we're going to look at why I think the bond bulls are going to be proven wrong for at least another 20 years. And bond bulls, of course, believe that we're going back to the old normal of 2% interest rates or near zero interest rates, low inflation, to the world that we had prior to 2020 from, around 2008, 2009. And before I start, though, I like to go through a couple of quotes that will probably help you understand why I believe in what I do. And one of the quotes as well is to show you that I have no crystal ball and that I'm not here to predict what's going to happen in 2023. It's more of a long-term thing, but it will give you a taste of what's to come, in my opinion. So the first quote is Ecclesiastes. And it says, there's nothing new. Life moves in cycles. There's no remembrance of the former things. Neither shall there be any remembrance of the things that shall come with those that shall come after. Basically, it means everything repeats. There's always cycles. And I think a lot of people, especially the Keynesians and maybe the bond bulls as well, they think in a linear fashion. They think we'll never see what happened in the past again, and I think it's because they don't study their history, to be honest. The other one is more to do with having a crystal ball. People asking, oh, so where do you think gold's going to be in 6 months' time in terms of the US dollar? Well, the gold price or any price is just an exchange rate, and it's very difficult to predict an exchange rate. But it's not difficult to know what will happen when people act in a certain fashion, and that's why I've gone to the introduction of The Triumph of Gold by Dr. Franz Pick, and the introduction is by Dr. Henry Jarecki, who was a friend of Franz Pick. And he says that Franz Pick never really predicted things, because he said he could know where a certain exchange rate or price would be in 3-6 months' time. Yes, of course, technical analysis helps you in the short term, but yes, I think it's pretty much impossible. So this is what he says here in the introduction. They were rather the words of Hosea declaring that the children of Sodom and Gomorrah were behaving badly and would thus come to no good. They were not, any more than Hosea's word, practical guideposts. Not at all. He knew more about when gold or currencies would go up or down than anyone else can in this random world. So this is about Franz Pick. And one thing I do know, though, is that we're continuing to deficit spend. You saw the 1.7 trillion omnibus bill the other day in the US. We had a record deficit spending in the UK for November 2022. We're seeing already people talk about the fact that if the cost of living crisis, and it's not a big if, I think it will, if it gets worse, that the government is going to have to come in, step in and help everyone. But government can only help by more deficit spending. So this is the bad action that I see that will result in no good, will result in more continued debasement of the currency. So with that, let's quickly go to why I think the bond bulls will be wrong for at least 20 years. And you will see why I'm saying at least 20 years. And of course, a bond bull believes interest rates are going to go down. They're gonna stay there, and we're going to have a world like we've had since 1981 up until 2020, where interest rates were on a downward path. We had lower highs and lower lows in interest rates, and we had the big everything bubble. We've had the financialization of the economy. And what does that mean, financialization? Well, it means that paper assets, fund management, hedge funds, speculation is a lot more important than the real economy. So it's a little bit like the tail wagging the dog, because finance and money should only help and facilitate the real economy. But with the era of low interest rates that we had from 1981 to 2000, that was turned around on its head. And that's what I think is going to happen in the next at least 20 years. And you'll see why in a second. We're going to have a different world. I don't know. As I said, I don't have a crystal ball. But I think it will be a world where things are going to be centered more on real things. Yes, finance and money will still be important, but not as important as they have been in the last 40 years. Easy credit or easy money is going to be a lot harder. It will probably be a more sober world. We'll have to see. People will have to earn their way in the world. Speculation will probably not be as rampant, because speculation, there's always speculation, of course, but not every Tom, Dick, and Harry will be able to do it. So that's what I see. So back to Ecclesiastes and why I think bond bulls are going to be wrong for at least another 20 years. I've spoken several times in the last 2 years or even more about the bond bull market we had since 1981. Well, it was actually September 1981. That was the top in the 10-year yield, just below 16%. That bull market up until July 2020, as you can see here at the bottom, in July 2020. And that's on a monthly basis, monthly close. I think in March, the 10-year yield went below that level, but we'll take it as a July bottom because it's all monthly here. I couldn't get the same chart going back to 1800, as you can see. So yeah, I've spoken about the 40-year cycle, and I got this chart from 1800 to 1990, and I put it together with this newer chart, and the scale isn't the same. As you can see, 1980 to 2020, that's probably a little wider than the previous chart, but you will get the idea of what I'm talking about. And you can see that the U.S. government bonds on the first chart on the left is the dotted line there. And there was a top in the early 1860s of the 10-year yield in the U.S., around the time of the Civil War, I guess. And then from then on, the yields dropped all the way down, and there was another bottom in the early 1900s, around 1902. So about 40 years, interest rates went down. There was a bond bull market in the US and other countries as well. There's some UK consoles there. And that was the age of globalization in the late 1800s, early 1900s, which is very similar to what we had from 1980 to 2020, I would say. But that's a different story. We're looking at bond cycles here. So this is the reason why I'm saying at least 20 years now, because it might not be 40 years that we're going to have rising yields or interest rates from now on. Because as you can see here, from the early 1900s up until September 1920, yields went back up, and they topped in September 1920, and then they went back down, and they bottomed in October of 1941. So that was 20 years up, 20 years down. And then from October 1941 till September 1981, yields went up again. So 40 years, just like back in the 1860 to 1900 period. This time it was up though, not down. And then from September 1981, we had basically almost another 40 years, about 39 years, and yields bottomed in July of 2020. And ever since then, they've been going up, and you can see that they've clearly broken a trend line that is there, which I haven't drawn, but you don't need me to draw it. You can see that it's broken. Yeah, I think we could have two scenarios here, at least 20 years of higher yields or 40. We'll have to see. And that's why I think real things are going to be more important in relative terms. It's not that they're going to be a lot better than they're now, but people are going to, go back to reality because the last 40 years up until July 2020 was a world based in mythical values, as President Putin said. And by mythical values, I mean fiat currency created out of thin air. And what that did is that inflated values of stocks, bonds, real estate, even commodities at some point, even gold and silver at some point. But I think the beneficiaries were mostly financial assets, stocks, bonds, and mortgages or real estate. And that's already as we've seen this year so far. And I'm not going to do a comparison right now because we still have a week or so of trading. We'll do it later on. But so far, up until now, though, silver, gold, commodities, they've outperformed all these paper assets. And I think that's a signal of things to come. And I'm not saying that bonds can't rebound like they have in the last few months. But the general trend is going to be that bonds are going to go down and yields are going to keep going up. And as we have so much debt in the system, I think there's over 300 trillion worldwide of debt. And those debts have coupons or interest attached to them. So, and when they come due, these debts, they need to be rolled over, be it by individuals, corporations, governments. And when they roll them over, the cost is going to be a lot higher. So the higher the cost, they're going to have to pass it on to the economy, to the consumer. That means more inflation. That's why I think the same people who thought inflation was transitory last year, they're going to be wrong going forward about inflation. And the other thing about an environment where interest rates or yields are going higher, it means that the discount rate for financial assets are going to be higher, so the prices are going to be lower, and that's why I think we've seen the worst year. I think it's probably like 100 years for both stocks and bonds. And that doesn't mean to say that I think it's going to continue next year, but generally speaking, I think that's going to be the way forward. And what that will do is that investors are soon going to realize, or maybe not so soon, some will, some won't, but eventually most will realize that they need to park some of their savings in real things like commodities, precious metals. It's just like in the 1980s. Early 80s, I think I remember a little bit of what was going on there. And a lot of people probably thought commodities, gold and silver, were going to keep going up. They didn't realize that the interest rate cycle had turned. And I remember I had a friend at university, and I think his father was in finance. And I think it was back in 82, 83, he said to me, well, my father said that stocks are going to go up now. And he was right. But of course, along the way, it wasn't like a straight line. Of course, like in 1987, we had the 20% crash in one day in October 1987. But they were just blips because the trend there, the cycle was still for lower rates. And I think it's going to be the opposite now. So there you go. I hope all of you have been enjoying your holidays. And I'd like to also wish you all a happy 2023. Bye.